Good morning, good afternoon, good evening, and welcome to episode number 2 of the Inside View Real Estate Podcast. My name is Carl Freund. I'm here with the very, very handsome Josh Zuniga, and today we're talking about the 2021 real estate forecast and will this thing actually crash? So stay tuned, it's gonna be a good episode. Anytime you inject that kind of money into an economy, there's gonna be people there, a very small segment that really take advantage of the system. And so, but we saw it very widespread. I remember, I used to own a mortgage company, and a big part of that branch was we actually owned a title insurance agency in-house, and AmeriQuest Mortgage was a very big lender in our area, and we had that account, we serviced that account. I remember going into the AmeriQuest office on a bright Tuesday morning. It was a Tuesday morning, and I remember exactly where I was. I went into the office, and I look over, and there's a dude cooking the books, meaning that he was literally filling out somebody's 1040 tax return, right? And basically,
this is a common story that you hear across the board.
Yeah, especially with some of the subprime loan companies. And so when we talk about the run-up is fundamentally different. In 2004, 2005, 2006, 2007, a lot of those subprime loans that were made on the assumption based on history that, look, if you invest in real estate, the prices won't go down, right? And so everybody got greedy. And greed is always going to be the driving factor behind a huge run-up like this, and then eventually a correction or a crash, as you call it.
Yeah.
And so when you look at the fundamentals in this run-up, really the run-up started probably late 2011, and now it's 2021, 10 years, which is basically an unprecedented run-up. And people can actually afford what they're buying now. So the income qualifications is a lot more stringent. Debt to income ratios need to be tightened up a little bit, meaning you actually need to make money to cover the mortgage and cover your outstanding other loans. And so what we're seeing now in the short term in the last year because of COVID and the artificial demand that's been created by the Fed by lowering mortgage rates, essentially lowering the overnight Fed rate, it created a lot of demand. And so we see that run-up. Anytime we see a huge run-up like that, we get like, oh shit, something's going to happen here in the future. And yeah, there is cause to be concerned because greed human nature plays into this a lot.
Absolutely.
And I do think that at some point we have to have some kind of correction because of the affordability. If rates ever were to increase, and they have to at one point, right? Because you can't get a 2.65% 30-year fixed right now. You're not gonna be able to do that in 5 years. You can't sustain that.
Yeah.
Cheap money like that, you're going to see inflation. You're going to see some upward price pressure. At what point do you have to be like, I can't afford that?
Yeah. So even going back, back to 2008. So you're saying there's a lot of things that obviously, yeah. There's a lot of things, especially in the lending industry, that set forth exactly what 2008 was almost going to happen. It was almost set up and completely. From the way it seems like as far as the subprime lending, the way you're telling me, even some of the lenders being incentivized to do some of these subprime loans and also taking these stated income saying, I make $100,000 when you actually make 50, but you still get approved for the house. And then when it has a balloon payment or interest payment, you're like, whoa, my payment went from $1,500 to like $2,200. I can't afford it.
Yep.
And is that the kind of thing that really happened when they started calling in these loans? And their payments just skyrocketed. And that's where the foreclosure rates really started.
Yeah, so we got really kind of creative back in the day. We would do like 3-1 ARM, which is basically, it's fixed for the first 3 years, and then it would adjust after that.
Okay.
And so we got into an environment where, as risk increases in the market, they have to compensate that through interest rate rising. And so if the rate went up, as you get that teaser rate, that 3.5% teaser rate for first 3 years, and then it goes to 5.5%. Bam, payment's another $500 a month.
Huge jump.
Yeah, for a lot of people, that's a big jump.
For a lot of families, that can put you in a hard spot, hard position.
You got to make some difficult decisions, right?
Absolutely.
And so you get into a situation where you got unemployment increasing. You've got, a lot of economic indicators pointing the wrong way. I was shorting Countrywide stock in 2005 because I saw the writing on the wall in 2005.
Yeah.
And I was way too soon, as I usually am. But what we saw there was, it almost was a light switch. Whereas here, the demand might decrease just a little bit. I don't think it's going to be a massive shock to the system as it was in 2008, 2009.
Yeah. Well, even since then, because of, in essence, the malicious lending that was going on and all the regulations now that are in place to protect borrowers or buyers, from, instances that happened like that in 2008, correct?
Yes.
It's definitely a lot more tight, as far as
It's
the
a lot
qualifications.
tighter. Yeah, absolutely. You don't have Countrywide making bullshit loans where it's like, it was called, Josh, it was called the fast and easy loan. That is literally what it was called.
Wow.
And if you had a 720 score or 730 score or some shit, you didn't need to provide any income docs, no asset documentation. They would do like 90% financing, no questions asked, cash out, the whole thing. I mean, it was ridiculous.
Yeah. For those of you guys that are interested in first-time home buying, it's definitely a different process nowadays where you have to come in,
qualify.
show your income, bring in your W-2s. If you're self-employed, you got to bring in all your statements, your P&Ls. There's a lot more, I would say, red tape to actually get you qualified, but it's also in your benefit because we want to make sure that when you get into one of these homes that you're fully qualified and you're going to be able to sustain this payment from whatever the term you choose, whether it's 5, 10, 15, or 30-year ARM, for it. So it's good. That's a good thing that actually came out of 2008. So it's obviously giving you some protection, right? Mm-hmm. So obviously, let's talk about like 2001. Thank you for the recap on 08. Obviously, that was a big mess that we all had to deal with. Yeah, I know my family was directly impacted, and they saw more than like a 50% drop.
Oh, everybody was.
In income, all kinds of crazy stuff. So we all had to make adjustments. Are we seeing indicators, either nationwide or even here within Phoenix for something like that to occur here within 2001? And I'm going to touch on this. I'm going to say no. It's just flat out no from here that we can see, especially like within Phoenix. Because as you know, and you were stating earlier, we're going to have to see a steady increase of the interest rates, correct?
In order to change that buyer demand enough.
Yes, the demand is
where
highly
it changes
strong.
the affordability index.
Correct.
So let me get something down for people that really can't visualize this thing. So a $300,000 house at 2.5%, the payment on that is a lot lower than the same exact house at 5.5%. Mm-hmm. So what happens is if interest rates increase, the affordability index has to come down. Mm-hmm. Because if your monthly income is fixed, and relatively it is for everybody, right? You have a ceiling. You say, hey, look, I make $5,000 a month. I can't afford, any more than $2,000 a month on a mortgage payment, right? If you get in that situation, you either get priced out of the market and you drop out of the market, the demand drops, or you say, hey, look, I'm willing to pay $250 for that house, right? So there's downward pressure on those prices. So I don't want to be a dick and say, yeah, there's going to be a market crash, but at some point, when is it going to become unaffordable? And what makes me very interested is human nature repeats itself over and over and over again.
Yeah.
There's going to be a greed factor where everybody's like, shit, Bitcoin went up. What did it go from like 4,000? Now it's at 36,000 today.
I might hit 40. Hopefully it's going to 50. I got a couple coins.
Do you got a couple coins? Yeah. I bought a shitload of Bitcoin at 4,000.
XRP
right?
Screwed me.
XRP got me right in the dick.
Done.
Yeah. So, but Bitcoin, you look at it, that's greed driven, right?
Yeah.
And you had everybody get on the bandwagon. They're like, well, shit, I'm going to buy it at 4,000. I'm going to buy it at, now they're buying it at 30,000, 40,000. They're still buying it because they think it's going to go to 100,000. Well, perception is a lot of that, right? And so perception drives an economy. If you're perceived to, be comfortable in terms of, employment in the future and you got, a good economy, people are willing to spend a lot of money. So if that perception of the economy changes and we start to become pessimistic, that's a very big leading indicator of bullshit to come in the future and say, look, if people aren't buying houses anymore, they're not spending money on consumer goods anymore, they're not taking trips anymore, they're not, they're starting to save more and spend less, they can have a massive impact on the macro economy. We're not just talking about the housing market, that's a macro thing.
Yeah.
And so when you break it down to just the housing thing, interest rates are going to drive it 100%.
Yeah.
Interest rates are the biggest driver of the housing economy.
Yeah, and I'm glad you mentioned perception as far as like the macro economy, because once you start infiltrating that into the media and into the news, and obviously especially now even social media, that hey, a recession is on a horizon, or we're in a recession and it's coming, people are definitely going to start tightening up really, really quick because of the fear factor, especially that they had from 08. And there's going to be a lot of families, even a lot of parents, even myself, they're going to be like, okay, boom, what do we have to do because something's about to hit? Do I have to liquidate some of my assets? Do I have to keep cash or to hold cash? What are we going to do? So that's definitely going to have a huge impact on exactly where the economy is going to hit. Do I foresee that happening? You never know. But as far as the interest rates, going back to that, there's a lot of statistics saying, even Forbes saying that they're going to remain low through 2001, potentially even through 2023.
Yep.
If that's going to occur, We don't know. But even with, let's go back to supply. So our supply here, when I last checked on Monday morning, actually I checked again, but I think we're less than 6,000 homes active currently within the Phoenix Maricopa market.
It's a misleading stat though.
Yeah.
So there's a little bit more meat behind there. So that's a great headline. Holy shit, there's only 4,500 single family homes available in all of Phoenix Metro. Problem is that we actually sold 10,000 homes last month. So what happens is it's just the velocity of the market is faster. So we're seeing homes sell instantaneously. They're not sitting in the market for
days.
10 days. They're sitting on the market for 10 hours.
Yeah.
That's the difference. So when you see that inventory number, that's only a snapshot, boom, at that exact time, but it doesn't show the flow. So, you have 10,000 homes coming on the market and 10,000 homes selling. So there's inventory there. So it's turning over. It's just turning over faster. The available inventory has shrunk a little bit, but there's new inventory to replenish. So if you start seeing it get below 4,500, we should be a little bit nervous, but it's definitely a seller's market.
Absolutely. And that just has to come because normally we're at like 70% of what we normally are at this time of year as far as what the inventory is supposed to be. So that means that would put us around 18,000 homes as far as inventory.
Yeah, we're at 30% of the available
exactly.
inventory.
So at that point in time, definitely the buyers are going to be, in a place where, hey, there's going to be a little bit more negotiation. Maybe we can ask on reductions in price, or maybe even closing costs, things of the sort. But here within Phoenix, that's definitely not the case if you're looking to get into the market, and that's why we say interest rates remain low, low, supply is remaining low, so that's still driving up the demand, and also the prices. That's the biggest thing, is the price. And eventually, like you were saying, we're going to have either correction when it comes to affordability because they can only go up so often. Nationally, last year in 2015, there was an average of 15% of appreciation. That's insane. That's wild. I know Maricopa County here alone experienced 18.5 or 19% appreciation. So if you own a house, you're doing well. If you're on the buy side, you're going to definitely have to be a little bit more patient, as far as things. But as far as if you're one of those buyers that is waiting and saying, hey, something's going to happen, is there going to be a crash? I'm just holding out. Well, they've said there's been supposed to be a crash, and I've been following for like the last 5 years now. And every year it just hasn't happened. Now, since COVID, let's bring up COVID a little bit. There's been a huge amount of evictions, right? Correct? Or at least obviously pending.
Well, there's pending evictions, not actual evictions, but yeah.
Pending evictions. You told me a stat a few weeks ago that just within Arizona alone, there's 65,000 evictions.
Pending evictions.
In Arizona. Not just within Phoenix, but within Arizona.
Yeah, that's the state.
Yeah.
Correct.
So we probably Phoenix has probably a little bit over a third of that, would you say?
I would say we'd have 70% of that.
70%?
Tucson's not that big.
Yeah. Okay. Yeah. So even with that has to do with like multifamily apartments and even landlords.
Single family homes.
Yeah, landlords that have tenants in there. So the landlords are probably in a really, really tough spot right now.
They are. If they don't have a federally backed loan and their person just stops paying, they still got to pay the mortgage.
Yeah.
Still got to pay the taxes. Still got to pay the insurance.
Yeah.
Where's that coming from? It's tough.
Yeah. And even obviously Trump signed the eviction moratorium in September. And then Biden just signed an executive order to extend it an additional 2 months.
Right.
How do you think that's going to affect the economy, or even here with us locally?
I mean, you're just kicking the can down the road. I don't like to do that. I like to just take my pain and, move on.
Yeah.
It's tough because we haven't had to deal with this in our lifetime, ever. How do you make economy thrive and survive through massive unemployment, through, all these hardships? The only way to do it is have the government prop it up. It's the only way, right? So they have to put money. Yeah, they're doing that. They're injecting, $2 trillion or whatever. Their new stimulus bill is $1.93 trillion. But on the landlord side, I feel for these people. I feel for both the tenant. And
I'm a landlord myself. Absolutely. I'm a landlord. Yeah, that's a scary thing to think about.
It sucks when you have to evict somebody. It sucks. It's the worst feeling ever.
It sucks when they miss a payment and you have to hit it. Or a second anyway. One. Yeah, exactly. Either way, it's coming out of your account.
Yes, it is.
No matter what. And a lot of these landlords, they're not making $1,000-$2,000 per home.
No,
sometimes just
like
a few $100. Yeah.
Yeah. And so
it's definitely a stretch, and that can hurt. That can not only affect the people that the tenants feel for them because you don't want to evict them, but then the landlord, he's got several mortgages that he has to pay, not just one that he has to worry about.
Yeah, there's a multiplier effect there for sure.
Okay.
What I'm worried about is that say interest rates go up, and then the eviction moratorium ends, massive vacancy. Where the hell are they going to move? move in with their parents, I guess, right?
That's always an option if you can.
What happens if the demand for rental properties goes down? Then you got a bunch of landlords that have vacant properties, right? What are they going to do? They're going to put the house in the market. Then the perception changes. And wait a minute, hey, look, the market's churning. We should probably sell all our homes. Massive glut of inventory. Then what's going to happen? Downward pressure on price.
Yep.
Perception. It's all about perception.
That's a big thing. Now, even coming in from like the landlord and a lot of these individuals that are, taking hits on on these payments, that can't sustain them, for obviously as we've gone over almost a year now, and now it's going to be continuing. Do you foresee a mass flood of foreclosures? Because I know that's a big question that everybody's kind of, wondering, hey, are there going to be any foreclosures? What's the foreclosure rate? Where are we at?
It depends on interest rates, depends on perception. I think if interest rates go up and public perception of the economy changes, and keep in mind that we just inaugurated a president, I don't know how that'll affect the economy. I really, really don't. I've been through this a few times now with 9/11, been through it with 2008 market corrections. There was a small correction in 2000 when the dot-com bust came. We always make it through. And so to finish out the podcast, everybody says, look, don't try to time the market, because you're going to get murdered either way. You just can't time it.
A lot of guys get crushed. Yeah.
Don't wait to buy real estate. Buy real estate and wait.
That's the golden nugget, ladies and gentlemen.
There it is.
Right there. That's the golden nugget. So just to wrap up, guys, do we foresee a 2021 market crash? It looks highly unlikely as long as interest rates stay low and the perception, within the market and within media, stays, on a healthy side to where there's not going to be any big or drastic changes, in the marketplace to where we're going to start making some really critical decisions to where we're going to have to offload and then supply just goes up and then interest rates go up as well. And that's where actually is like the trickling down effect. So if you guys are interested in obviously staying tuned with us, as far as what the market crash is going to be, we're going to be talking about if now is the right time to sell, now is the right time to buy. So keep in tune with us, guys. We're going to see you on the next episode. Thank you so much for tuning in. See you next time.